friends. On behalf of ABP Group, I would like to thank all of you for joining us today for this exciting virtual insight session on growing your wealth in turbulent times. This investor awareness session is being brought to you by Virtual Insights, ABP's virtual sessions platform in partnership with Edelweiss Mutual Fund. The objective of this investor awareness session is to provide you with all the insightful tips and ways to grow your wealth through smart investment so that you can achieve your financial goals despite these trying times. Here are a few highlights of the session that will be covered by the panelists: financial planning to grow your wealth in the new normal, modes of investment that are relevant today, special tips for young and salaried groups to start accumulating wealth, and creating and protection of funds. At this point, we all must be aware that mutual fund investments are subject to market risks, and you must read all scheme-related documents carefully. Well, we are very honored and privileged to have with us our esteemed panelists for the session. Let me briefly introduce them to you. Our first panelist is Mr. Deepak Jain, who is the head of sales, retail and institutional business, Edelwiess AMC. Now, with 17 years of experience and a FCA from ICAI, Mr. Deepak Jain heads the sales for Edelweiss Mutual Fund. Mr. Jain joined Edelweiss Asset Management in the year 2018 as the head of retail sales and was responsible for distribution of mutual funds, liquid AIFs, and PMS. Later, he was also entrusted with the responsibility of handling institutional sales. Before joining Edelweiss Asset Management Limited, he was head of retail sales at DSP Mutual Fund for South and East region, in addition to heading the online distribution channel. His stint in the company lasted for 12 years plus. We welcome you, Mr. Deepak Jain, sir. Our second panelist is Mr. Shibu Das, who is the Director of Fine Advice Private Limited. Mr. Shibu Das was born and brought up in Visakhapatnam. After graduating in chemistry, he realized that he had a passion for finance and pursued accountancy. He qualified as a chartered accountant in 1989 at the age of 22 and started his independent wealth management practice. Mr. Das has over 3 decades of experience assisting individuals, families, and institutions with tax planning, estate planning, wealth management, wealth creation, asset protection, wealth transfer, and investment management. He is the founder, director of Fine Advice Private Limited, one of East India's most trusted and leading financial services firm. Fine Advice has won several accolades and awards for leadership in the financial services business in East India. Fine Advice also has several clients across the globe. It works very closely with several NRIs based in countries like the USA, Canada, Australia, UK, Dubai, Singapore, Bangkok, Austria, China, and Mozambique. Mr. Das is a fellow of the Association of International Accountants UK and is also a certified financial planner from Financial Planning Standards Board, USA. He is also a certified CSR professional of the Institute of Chartered Accountants of India. We welcome you, Mr. Shibu Das, sir. And this interactive session will be moderated by our esteemed chairperson, Mr. Saumitra Dasgupta, business editor of the Telegraph. In a career spanning over 3 decades, the Telegraph's business editor, Mr. Saumitra Dasgupta, has lived and worked in Delhi, Mumbai, and Kolkata. He has written and commented extensively on a wide range of economy, business, and trade-related subjects. We welcome you, Mr. Saumitra Dasgupta, sir. We welcome the panelists and the chairperson and all the attendees who are joining in from various locations. We have had a phenomenal response for this session from various locations, and we are very keen to bring forth an insightful discussion today. Just a few instructions before we begin. The interactions will be for about 45 to 50 minutes between the speakers, and the last 10 to 15 minutes will be the Q&A session. If you have any questions, you can post them in the Q&A box, and the chairperson will take the questions at the end of the session. We request you that you keep your questions to generic questions about investments and other related mutual funds, but please do not specifically ask about any particular fund or any other any particular brand. We will not be able to answer that. We will be able to give you insights about the overall investment patterns and how you should take care of them. And without any further delay, let me hand over the session to Mr. Saumitra Dasgupta, sir. Our panel discussion today on the theme, Growing Your Wealth in Turbulent Times. Over to you, sir.
Good evening. I thought it would be a good idea to kick off this webinar with a quote from Warren Buffett. the world's best known value investor. More than a decade ago, there was an interview where he said the world's first investment primer was written by Aesop, the famous Greek storyteller, which was way back in 600 BC. What Aesop wrote was an aphorism. A bird in the hand is worth two in the bush. Buffett says that one needs to amplify on that nugget of truth. He said that Aesop forgot to tell us when you as an investor can get those two in the bush and what the interest rates are. Investing, he said, is simply figuring out your cash outlay, the bird in the hand, and comparing it to how many birds are out there in the bush and when you can get them. For investors like us, we already have to figure out the animalistic confrontation between bulls and bears in the market, and to have to also deal with the ornithological significance of counting birds in the bush, perhaps is a little too much for us to do. But we have two eminent experts on our panel today, Mr. Deepak Jain, Executive Vice President and Head of Sales at Edelweiss, and Mr. Shibu at Fine Advice, who will hopefully unravel for us the secrets of investing through mutual funds and explain the riddle of the Sphinx. Let me lob the first question to Mr. Jain. The global market meltdown of 2008 was labeled as a black swan event, and that was prophesied by Nassim Nicholas Taleb. The outbreak of the COVID pandemic last year, once in a century event, was a lot worse. Markets went into a dive but recovered very quickly, displaying remarkable resilience. So what are the lessons that we as investors have learned during this pandemic?
Thank you, Mr. Saumitra, for inviting me over to this session. Interesting question to start this session with. Learnings from past 12 or maybe 15 odd months of pandemic. I think the one most important lesson that we learned is that it's important to plan for something that you haven't really thought of. So basically what we call as emergency cash, that needs to be planned very, very well. Maybe not just for 3 months or 6 months, but maybe a little more than that is what we have all understood. The importance of planning and planning for your long-term goals couldn't have been overemphasized from the learnings of the last 15 to 18 months. We have seen job losses. We have seen things that we haven't really, thought of. Last 15, 18 months, I personally have worked from home, and we never thought that this was even possible for 15 days also, 15 hours also. We used to travel to work day in, day out to meet the ends. But last 15 months has really changed the way we think. There has been a paradigm shift in terms of how do you think about your investment and savings need. So I would start with these two, which is one, planning and planning well for your most important goals like retirement, the key thing in your life that you would like to, be funded with at all points in time. And the most important is planning for your emergency needs.
Yeah. One of the things that we have seen is how the markets have recovered since the pandemic. I mean, that has been a huge surprise. The ebullience of this market, and especially in the context of the fact that the economy was going through a very trying sort of situation. And we closed, of course, FY21 with a contraction, minus 7.3, and then get walloped by the second wave. So this, and then we already, talking about this looming third wave. So a question that I think all investors would like to know is what is the basis for this market's ebullience? And what is the implication of this ebullience for the fortunes of the mutual fund industry and returns for investors in funds?
So it's a very, very important question that you have asked. And let me bifurcate the answer into two parts. One is about the fall that we saw in the month of March and the resilience that came after. And the second is what is going to be the impact of this on an ongoing basis. Now, once you look back and look at the shutdown that happened, the lockdown that happened post 23rd of March, April, you went down to almost zero economic activity. Now, if you believe in the fact that markets discount the future, market looks at the future, the worst as far as economic activity was concerned was seen in April. You couldn't have gone down to zero again. So market fell from almost the highs of 50,000 to almost 27,000. It's a almost 44-45% fall. From there, people would like to evaluate their position. People would like to see, is this April phenomenon is once in a lifetime, as you said, once in a century, sir, or is it going to continue forever? So in the collective wisdom of the market thought that April, the worst of the economic activity is behind us. Whatever is going to come is going to be better than what we saw in April. And that played out pretty much. And markets started to see that early, as they always do. Also, when you look at valuation, when you value equity, you are not valuing businesses from a one-year cash flow or one-year economic activity perspective. Most businesses are in for perpetuity. So you would like to value the cash flows of a business over a 10, 20, 25-year period. And if you were to do that, you would find that that drop that happened in April, and perhaps you can extend that argument up to the entire financial year, but it was primarily to do with April economic activity. It was only a small portion of the entire valuation chain that you would like to look at over the period of 10, 15, 20 years. And hence, the market, in its wisdom, bet positively on the future. And it really worked very well for people who invested. The second way is also to look at globally. Central banks came in and slashed interest rates. I mean, we saw that in India also. Liquidity was made available to everybody who really wanted, whether it's global investors, domestic investors, global businessmen, domestic businessmen, so on and so forth. When you value any business, interest rates are very, very important. So from a higher level of 6, 7, 8% on a 10-year basis, even for a 1-year basis, it came down crashing all the way. Overnight started trading at below 4%. So you could actually see that money was available cheap. So when interest rates come down, your expected returns for equity also comes down, and it's basically a simple math. So people are willing to expect a lower return from their investment, and hence the valuation may look a little stretched at a current level. The second part of the question, sir, is are the learning from these last 12, 15 months in terms of behavior of the market, and how is it going to play out? I would like to point out one very important phenomenon that we have seen in last 15 odd months. We've been talking about it, the emergence of Robinhood investors, basically retail investors coming to the fore globally. Data suggests that in last 15 months, the number of demat accounts that have come up in India, for instance, have been, it's been multiplying. So just to give you a data point, we now have more than 5.5 crore demat account holders in India. Compared to May 20, the registration in May 21 is 4 times. We have seen that across the globe. Korea, for instance, we saw in last 15 months, the institutional investors selling almost close to $60 billion, but markets went up 20%. Why? Because all of that selling was absorbed by retail investors. So I believe because of the pandemic, because of the learning that people did in terms of their savings and cut down on expenditure, especially on the discretionary side, a lot of savings was then parked into equity market. Also bolstered by the fact that there is a TINA factor of lower interest rates.
Yeah, I just want to turn to a question to Shibu. Basically, the pandemic has forced mutual funds and investors at large to I mean, has the pandemic forced mutual funds and investors to reassess their investment philosophy and goals? And also, as Mr. Jain just said, it has also tempered your expectations of returns as a result of the slowdown and, as you said, the lower interest rates. How has this affected choices of investors in terms of funds and schemes and all of that? Could you throw a little light on that?
Okay, good evening. See, basically, investors have become much more resilient. Investors have become much more smarter these days. We saw such an event in 2008. The reaction of investors at that point in time was a complete panic. They thought that was the end of the world. But when they saw that 2009 we recovered, and from 2009 till the pandemic, that's 2020, 23rd March, that's almost an 11-year bull run globally. The investors have, even the retail investors have realized that staying put in the market is a better idea than getting in and getting out. You cannot time the market. This is point one. Point two is that people are now looking at various options to de-risk their portfolio. Earlier, investors in India were only looking at what we call as fixed return instruments, bank deposits, in mutual funds also the safer variety. Slowly, the retail investors started investing in equity funds. Now they want a portfolio that's got global funds also in it, because they realize that in this kind of an event, lower the correlation between different economies, the better it is for the portfolio. And Indian economy or Indian stock market has a very low correlation with US market. So they are looking at other avenues of investment also, like global funds. So I think this is one major change. The other thing which Deepak mentioned very clearly, emergency funds. I'll just get back to that earlier point. Earlier, it was a truth, almost a truth, that 3 to 6 months is good enough. People have now realized that you almost have to have an emergency fund of 1 year at least to survive. And people have become a little more frugal in their spending. They are probably realizing that living within means is not a bad idea at all. I mean, you don't have to go and buy things you don't need. Because if you do that, Warren Buffett said, if you want to buy things you don't need, then you'll end up selling things you actually need. So I think people have become more frugal. People have realized that they have to build a proper emergency fund. They have also realized that diversification is a good idea. They have understood that what is a need and what is a want. They are now looking at things that they need rather than what they want. I mean, they need a two-wheeler. People don't want to move in public transport anymore. So come what may, what was once a want for a certain segment of the society, that's a two-wheeler, today has become a need. So they're cutting expenses at some other, wherever possible, and trying to buy a two-wheeler. So these are some of the major changes we have seen in investor as well as consumer behavior also over the last 12 months.
Yeah, given the fact that Indian investors are naturally thrifty, thrift is sort of inbuilt into our DNA. And to that, if you add what you're calling frugality of spending, how does this have any sort of implication on the assumption of risk? I mean, in terms of investment, the fact that your FD is not giving you the kind of return which is even catering for inflation. So obviously, I mean, there'd be a natural tendency, and we've seen that because out of your 33 lakh crore of mutual fund AUM, almost half of it is retail investor, putting his funds there into mutual fund schemes. So obviously, there has been this this great retail rush for mutual funds. Have you noticed any the trade-off on risk with respect to mutual fund investment?
Oh, yes, at the retail level, definitely I can see that, because once the fixed deposit rates have actually come down to around 5%, and with the 30% taxation, you end up 3.5% when inflation is 7-8%. So people know that putting money in a bank, which is supposed to be safe, is actually not safe. You're risking your purchasing power. And people have also noticed one thing, that what is supposed to be risky, that's equity investments, over a longer period of time has generated phenomenal returns. I mean, talking about mutual funds without taking names, there are schemes that were launched 25 years back. I mean, many of them, not any specific scheme. The NAVs of a 10 rupee unit today is around 1,700 rupees in 25 years. That is 170 times growth, which translates to something 20 plus kind of a CAGR. I'm saying, even if you don't look at that kind of a return, who stops us from expecting a return of 12% CAGR over the next 20 years? Very much possible. So that's where the trade-off between a 5% taxable at 30% vis-a-vis a 12% paying a 10% long-term capital gain tax. So the arbitrage between these two instruments is so high. So there's a natural shift from these kind of bank fixed deposits. It's happening slowly, but it's happening. Mutual funds.
Okay, Warren Buffett, had this theory about investors and investment behavior. So I just wanted to focus a little bit on investment behavior. He said that investors are really manic depressive, euphoric when the market is up, and completely down in the dumps when the market sinks. So as a financial advisor, how do you counsel investors to imbibe the virtue of patience and accept the truth that you cannot achieve all your financial goals in a jiffy?
Yeah, I mean, this is something we have been trying for the last 30. I have been trying for the last 30 years. I mean, to explain to a person that you're an investor and not a speculator. So when it comes to investment, I mean, if you take the perfect way to explain it would be, a speculator is one who looks at technical analysis. He looks at charts, he looks at all that and tries to trade it on a day in and day out basis. An investor is one who looks at fundamentals. So we keep telling people that over the last 50 years, if you see, or over the last 70 years, the stock market will move up and down, but eventually they move up. If you believe the stock market eventually is going to move up, then if you want to create wealth, if you want to safeguard your future, you have to be partially in the stock markets to really beat inflation and make some meaningful wealth.
Yeah, Mr. Jain, I just wanted to ask you, how important is it to sort of set financial goals for an investor? I mean, how do you decide on these financial goals? And do investors need to recalibrate their goals with respect to age and changing circumstances?
So to answer your first question with regards to how important it is, I think it is very important. It's like, buying a ticket without knowing a destination. You can't do that. I mean, you can do it once in a while, but you will end up in a place where you don't know what to do with it. So it's important to really define what you want to achieve, whether it's, just a return, or you're just doing a trading, or you're actually saving for a long term, trying to create wealth, whether it is, growing your retirement corpus or meeting a certain goal, whether it is housing or some other dream that you may have to start your business at some point in time if you are in a job. A goal really puts some kind of a discipline. And let me just dive into a question that you asked Mr. Das before. What has really changed in terms of investor behavior? I think a lot of discipline has come from really dabbling into a market and thinking it to be some kind of a magic which will just make your money double overnight. People have realized it is not the case. And it is not also a place where you need to be scared of if you're disciplined. So in two forms, for investment through SIPs, for instance, have really taken a many fold kind of a jump. Today, on a monthly basis, investors park in almost 8,500-9,000 crores of money through SIPs in mutual funds month on month. Also, emergence of solution-oriented products like hybrid funds, etc., have also set the right expectation and discipline in the approach of investors. And the outcome has been fairly well rewarding in last 10, 15 years. So that has really changed the course and made investors more, faithful, more, believing in the market story than they ever were.
Okay, I just wanted to ask you about, first-time investors. I'm sure there are a lot of people in the audience who are going to be first-time investors or are already just, considering the idea of getting into the mutual funds. So is there any way to time your entry into mutual funds? I mean, we discussed this and we said that there's no way that you can time the markets. There's no way you should look for it. But many people would look to, look at maybe NAVs and see whether the NAV is falling, and then I'll wait for it to fall a little. If you're going in as an SIP investor, does it really matter at which point you sort of enter the market?
So I think for first-time investor, it's important to understand the entire, product range or product category range that mutual funds have to offer. Sometimes people equate mutual fund with just high return, high risk kind of a product. It is not the case. You can invest in a liquid fund, which is an equivalent of, or dare I say, similar to what you do with your savings into a bank account, or you can do a pure play diversified equity fund, which will replicate the risk and rewards of a stock market portfolio. In between, you have hybrid funds which invest in both equity and debt. So I think it's important to first understand the entire landscape. It's a great way to start from an SIP, but also to understand what exactly you want to do with your money. If you're let's say a fresh starter, you've just started a job, you're anywhere between 25 to 30. Yeah, I mean, you can plan for a 5-year goal also, which may be a car that you want to own, a 15-year goal, which may be a house that you want to own, or a 25, 30-year goal, which may be the retirement corpus that you want to build. So on the basis of the goal that you set for yourself, and by taking an advice of somebody who can actually help you in building for that or providing for these goals, I think one can start. But SIP is a brilliant way to start. And I would also encourage people to look at hybrid funds. That's a category which is very good for any retail investor with some kind of a 3 to 5 year kind of a horizon to come up with in the market.
Mr. Das, I just wanted to bounce this off you. I mean, how important is it to have a financial advisor to handhold a first-time investor through the process? And the question obviously also is SIP or lump sum investment, which is the preferred choice for a first-time investor?
To answer the first question, how important is it to have an advisor? Well, how important is it to have a teacher in the classroom? I mean, everything is available. You just Google, you'll get all your physics formulae and physics diagrams or chemistry, everything. Why do you need a teacher? You can teach yourself. Well, some students don't need private tuition. That's fine. Some need. So if an investor thinks he can read through all the tons of information that's available and convert that to knowledge and have the wisdom to actually act on it, then I would say advisor is not required. If somebody is focusing on what he does best in life, that is making money in his own profession, he should actually have an advisor. Two things. One is for the skill sets, that's the domain knowledge an advisor brings on the table. Number two is somebody who will be an emotional guru for him. Because no matter how smart you are with the subject, when the tide turns, when the bad time comes, you need some kind of an emotional support to say, okay, these things happen in the stock market, stay put. So that's where an advisor has a great role to actually play. Coming back to the second question, I think that was about SIPs, right?
Yeah, SIP or lump sum.
Yeah, SIP or lump sum. I mean, if you have money, lump sum. If you have money coming in the future, it's SIP. I mean, that's a very simple question. So people keep asking this, that if I have money in a lump sum, should I put it now? Put it. Because if you're looking for funding a goal that's 20 years away or 40 years away, how does it matter whether the markets are 5% up or 5% down over a 20-year period? you would hardly have a 3-4% kind of a difference. And SIPs are basically meant for people who are planning to deploy future income. Now, the other point I always keep telling young people who come to me seeking some sort of an advice about what to do with their money. First thing I say is that, see, if you're 20 years old, start with 1,000 rupees SIP. By the time you retire at 60, you would have something like 1 crore 20. Now, if you delay this and start at 40, for the same amount of ultimate corpus of 1.2 crore, you would have to invest 12 times every month. So this is a thumb rule. At 20, if you invest 1,000 rupees every month, in the next 40 years, you would have 1.2 crore. If you delay that by 20 years and invest only for the next 20 years, you would have to invest 12 times that amount. That's 12,000 rupees every month to reach the same target. So start early. This is the mantra, no matter what it is. I'll give you another small example if time permits. See, the moment a child is born, there is an 18-year time for the parents to actually create a corpus for their future education. Now, suppose the ambition is to send them abroad. It costs 1 crore today. At something like a 4% inflation, it would cost 2 crore by the time the child is 18. If I tell the father or the mother that you have to save 25 or 26,000 rupees every month for the next 18 years to reach this goal, then that would be a put-off. They would get shocked. What we normally tell them is you start with 5,000 rupees, increase this by 5,000 rupees every month, every year. So you start off in the first year the child is born, start with the 5,000 rupees SIP. Second year, make it 10,000. Third year, make it 15,000. You'll be getting increments. Your salaries are going up. So start with 5,000, increase it by another 5,000 every year. In 18 years, you would have 2 crore rupees and your child's education and everything is funded. So these are the things we normally try to tell the new set of investors. Some of them actually are carried in with the numbers, and these are numbers that assume only a 12% CAGR. I mean, that's something we can easily expect over the next 15, 20 years.
Yeah, Mr. Jain, I just wanted to look at, people have started, as you said, dabbling, and also the fact is that, because of the approach to investment, that people have started looking at overseas funding also. So you have these international global fund of funds where, the data points are showing a lot of money going into these global fund of funds. What kind of returns could one expect from that kind of, an investment?
It's an almost impossible kind of a question for me to answer in terms of returns. But I'll tell you why exactly people have been trying to look at some of these international investment. When we invest, we want to capitalize on the business opportunities that we see around. So, for example, if we are consuming shampoos, etc., we would like to buy Hindustan Lever. I'm just taking a name of a business, not necessarily part of any portfolio. Similarly, if you want to participate in, let's say, infrastructure building that is happening in the country, you would want to buy a cement stock or a steel stock. Similarly, when you see that Apple phone are getting consumed, your television comes from abroad, the Zoom platform that we are on is not listed in India. So many great businesses are not available in India. People would like to participate them because there is a familiarity advantage that we never had before. We had a home bias. That bias is turning into familiarity. I think that is what is driving people to buy some of these international funds, and the returns are representative of the growth of those businesses. So if X business grows by 15, 20, 25%, the stock price most often than not replicates that kind of a performance. So it's not right for me to give any number, but depending upon the fund or the underlying securities that they are buying, I think the returns would be pretty handsome if they made the right choice.
One of the biggest problems before investors, any investor, I mean, he's daunted by the fact that there are more than 1,600 schemes which are available. I mean, that's enormous amount of schemes from which he's got to pick. How does he understand the myriad categories that there are and make those choices? Of course, I mean, you have the financial advisor. That's why you need the financial advisor to advise them. But in terms of choices, what kind of factors come into play when you make those choices?
Is the question to me?
Yeah.
Okay. So, I mean, there may be 1,600 schemes, but thanks to recent categorization by SEBI, they have been bucketed under almost 40 odd categories. Fixed income side, 10 on equity, and then there are some hybrid and thematic funds too, also been included there. So, it's not the number of schemes or the category, it's about what exactly you are looking at. If you're a first-time investor, then schemes are relevant to you. But if you are a seasoned investor, perhaps you may want to graduate from just investing into plain vanilla schemes than to thematic schemes or international funds, for example. The choices are really important. The choices should not make you get your decision hampered, but it should actually empower you to be able to do what you want to do for yourself. As you rightly said, an intermediary, a financial advisor, a mutual fund distributor can help the investor pick out the right kind of schemes and right fund at the right point in time. For example, if I'm only looking to park money for next 15 days, liquid fund is the fund to go for. But if my objectives are different, then there are various schemes. So we should not really be bothered about number of schemes. There are schemes which are in those categories, and you compare those schemes in terms of their performance and consistency, the portfolio, so on and so forth.
Yeah, let me lob that question to Mr. Das. And in terms of, basically this thing was, does age determine choices of funds? And circumstances, goal setting, how do these define choices?
Okay. Yes, age definitely defines the choice of funds. Now, when we have to actually differentiate between specific schemes and specific funds. When we're talking about a fund, I'll put it this way: a fund is something which denotes a category. So at 20, a person has got another 40 or 30 years to save. So he can be 100% aggressive. He can actually look at schemes that are 100% into equity. But when you're closer to retirement, we would say taper it down a bit, select schemes that are in the hybrid category, or maybe once you're past retirement, there are retirement solutions that are there. So we should actually move to those kind of categories and then select the underlying schemes there. So certainly age is a factor that will define which category we have to invest in.
Mr. Jain, I just wanted to focus on, this wave of digitization. What role does digitization play in the mutual fund industry? Everyone's going in for, you've got apps, you've got websites and all of that. The back end is being improved all the time. How important has that been in changing the fortunes of the mutual fund industry? And what are the expectations that investors can have about, the changes that will happen as a result of this?
Digitization should be looked at as a all pervasive kind of a concept and not necessarily limited to mutual funds. We are seeing people's need not to even visit their banks, for example, and your phone is your bank, your phone is your restaurant, your phone is your school today. So why not your phone is your investment house? So digitization is really very important. It has really helped people transact with convenience, with ease. Number of errors have come down. So I think it's to be seen in the entire context of people moving from paper to non-paper. And I think it has really helped people do more transaction. Distributors are also being able to service more clients, less amount of paperwork. So for example, today, exchange platform allows a distributor to initiate a transaction on behalf of a signed client. So that's fantastic. It was never to be imagined 10 years ago. You had to fill each and every form, and along with that, all the documents that were required to be filled. So I think convenience has really opened up people's views about investing, and it has really leapfrogged. So as of May end, the number of folio that mutual funds have crossed 10 crores. That's really a number to be really proud of. I'm sure this will double and triple and quadruple in times to come, but 10 crore is a good start.
Yeah. We spoke a little while ago about thematic funds. I mean, is it a good idea to go for, the flavor of the season thematic fund? I mean, would you counsel investors to exercise those choices? Or would you say that unless you understand the theme, please don't get into that fund?
I think your question itself has answered. I think you have made my job easier. If you don't understand the theme, don't get into it. You have choices. If you understand, if you are prepared to take a little more risk for the extra reward that you seek, I think there is no harm in looking at thematic funds. Globally, thematic funds have been doing very well, whether it is consumption-driven theme or technology-driven theme or a geography-driven theme. Those themes have been doing well, but of course, those themes also come with their commensurate risk. So if you understand, or you have somebody who understands and is willing to take that risk for you after explaining the entire context, I think it's worth your while. It's a good choice.
Okay. I just come to the same sort of question, a couple of questions regarding, this. This is a question really to Mr. Das. Growth funds versus dividend option. I mean, this is the choice that everybody sort of faces. I mean, should I go into a growth-oriented fund or should I go into a dividend option? How do you advise investors, between the two? I mean, is there a difference in terms of returns, in terms of, choices? How does it work?
2 years back, this question was relevant. Today, it's just a simple answer that growth is always better because of the tax regulations that have changed over the last 2 years. So earlier, equity dividends were tax-free. There was no dividend distribution tax implication. Now there is a taxation on equity dividends also. So growth is a better option. If you want a steady cash flow, earlier people used to go for dividend, but dividend becoming taxable, it's better to go by a SWP route, which is actually a systematic withdrawal plan. So that solves the tax problems. Growth is a better option.
Okay. The question that we were talking about this emergency fund. I mean, what is the nature of this emergency fund? When I have an immediate requirement to create, as you said, an 18-month or a 1-year emergency fund. Where would you park this money? I mean, this emergency fund would consist of what in terms of investment?
See, pre-pandemic, it was very clear emergency funds were for 3 to 6 months of your monthly spend. So just to take care of your bills. When it was just 3 to 6 months, the solution was very simple, put it in a liquid fund. They give you low returns, but then you're only parking 3 to 6 months of your expenses. So it doesn't make a difference. But now when we are saying that you have to park at least a year or 18 months of your expenses as emergency fund, then we could have the first 6 months in liquid fund, be slightly aggressive with the next 12 months of the corpus and generate a little more returns. So I think the structure can be tailored in such a way that 6 months you have it in completely liquid funds and the remaining 12 months of emergency corpus, you have it a little more aggressive. That's what we would say, because we are not very sure whether that emergency would actually happen or not. Yeah, Deepak.
Yeah.
So I think there have been an emergency. Sorry, just wanted to add to this question, to the answer that Shibu gave. There has been an emergence of target maturity funds. So these funds come with a targeted maturity. So for example, let me just explain this to our larger audience. So like an FD matures on a given date, these target maturity fund also matures on a given date. So there could be a 22 maturity, 23 maturity, 2030 maturity. Those are the various kinds of maturity bucket that you may find. So if you can match the maturity bucket and ensure that the fund is liquid enough, I think that could be a good solution to start with.
I just wanted to, the fact is, when we started off this discussion, we were talking about, how interest rates are extremely low. And we were saying the call money rate, for example, is just around 3%, 3.2% or so. Obviously, there's a lot of cheap funds, sloshing around, and there are no takers for it. But at some point, interest rates will start moving up. That is the expectation. When it does, how will it change the perceptions about investment in mutual fund schemes themselves in the categories that you've talked about?
The question to me?
Yeah.
Yeah, see, interest rate cycles will have their ups and downs, like we have always seen. But if you look at the commentary from a near-term perspective, you either you look at US Fed, you look at ECB, you look at our own central banker. I think lower rates are here to stay for a little long. I can't say for perpetuity, and I'm not a rate expert, but I think lower and moderated rates are here to stay for a longer term. Because we have seen just in last 12 months how the global economy have taken a deep dive. So for it to rebound and become more normal, I don't think so. Central bankers would rush in, will be in a hurry to raise rates from here. They may keep talking about it. There may be taper tantrums in US. There may be some talk about inflation related worries, etc. But I think, and then this is what we have discussed with our fund managers internally, is that this regime, the lower and moderate interest rate regime, is here to stay from a medium-term perspective. Whenever that changes and rate starts going up, there would be adjustment that would be made to valuations of various securities, whether it is equity, bond, and even hard assets. So I think one needs to be able to adjust one's portfolio accordingly at that point in time. But there is no need to really prepare for that kind of an eventuality at this point in time, where we are not sure when is it going to happen.
Yeah, Mr. Das, I just wanted to ask this question, and this is basically, how often should an investor, look at his portfolio and reassess his portfolio? Should it be maybe 6 months, every year, with or without his financial advisor's help? But in a market which is, with a lot of uncertainties in this market, and it's been pretty volatile over the past year, although the market has been booming again, and the expectation is that it will boom some more. But how do you see investors, would you advise investors to look, at the portfolio, or just forget about it? You've invested, you've set your goal, 12 years, just don't look at your funds, don't tinker around with your original investment.
So if an investor has got his goals very clearly set, and the underlying assets are actually created in such a way that they are planned to meet a particular goal, while review of the schemes and performance of the portfolio is important, more important is to see whether his goals have changed or not, whether his life circumstances have changed or not, whether there are any events in his life that have a lasting impact on his goals. So I think while a review is very important, a periodical review, maybe once in 6 months, once in a year, for long-term goals, what is more important is seeing whether his goals are in place or not, and whether they're being met by his existing portfolio. So we can always look at portfolios and see underperforming ones, maybe tinker with them, but too much of tinkering doesn't help.
One of this thing is the ELSS funds. These are basically for people who are into tax saving. Is that, how important is it to have an ELSS in your portfolio?
So it's an opportunity, because if you compare ELSS with the other investment avenues available for saving tax under Section 80C, I think this is one particular investment avenue that's given the highest return. There's no comparison between ELSS and any other instrument that offers tax saving under Section 80C. So I would definitely say that apart from Provident Fund and some element of PPF, what is there, the remaining should definitely be in ELSS. And if you compare any other tax saving instrument, a Provident Fund is locked till retirement, or PPF is locked for 15 years and plus 5 years and so on and so forth. ELSS is the best one. You have liquidity after 3 years. You can use the same amount of money, keep churning it after 3 years to save taxes. So it definitely must be a part of an investor's portfolio.
Mr. Jain, I just wanted to ask this question, and that is, how many schemes should an investor have in his portfolio? I mean, is there, this is something which is left to individual choice or financial advisors' advice, or how many do you recommend?
I understand the context of this question. It's a very important question. I think there is not there is no formula whether you should have 5 or 7 or 10. But in short, I would like to say that you shouldn't have too few and you shouldn't have too many. I mean, it's like a portfolio. If you have a 200 stock portfolio, I mean, you would be all over the place. But if you have only 4 stock portfolio, there'll be huge concentration risk. So a right balance which covers all the aspects of your investment in a manner which where you achieve the goals of diversification, liquidity, and investment capabilities, which is available across the market. So if you look at various fund houses, for example, a certain fund manager or certain fund house may be good in X, Y, or Z type of investment. The other could be very good in something else. So if you have enough, which I mean, I don't want to put a number to it, but maybe 10, 15, 20 schemes covering all kinds of investment, I think that's enough. But there is no formula to really subscribe to.
One of the questions that investors normally are afraid of is a situation of uncertainty which leads to redemptions and in schemes. We've seen that in the second quarter of last year. Obviously, the after that dip where we saw the redemptions, the money's come back. But when redemptions happen, I mean, how does that affect returns? I mean, do redemptions, very heavy redemptions in a scheme, have an impact on returns in that scheme for the others who stay invested in that existing in that scheme?
So it's a very important question, and this is something that we really at Edelweiss, and I'm not talking about scheme, but from an investment philosophy, really take care of it. So your portfolio should be such that you should be able to liquidate at a market price. If you are not able to liquidate at a market price, that has an impact cost. And that really makes people who stay behind suffer. So yes, one must look at the liquidity of the portfolio that you are investing in. If you do so, I mean, there are various ways of looking at it. Your advisor can help you. Your fund house which you want to invest in can provide you data. But if the portfolios are fairly liquid, the redemption doesn't really hurt. But if the liquidity is at a premium, which we have seen in some of the fixed income funds in last 1 or 2 years, that can cause some bit of pain to investors. So it's very, very important for you to look at the liquidity of the portfolio. What can you do other than that? Something which is in your control. I think asset allocation is a very important tool to use. So create a portfolio which can give you access to liquidity or liquid cash at any point in time by investing a right mix of into fixed income, liquid, equity, so on and so forth. If you do that, the need to sell at a distressed time would go away.
Okay.
There are a lot of questions coming in. Would you like to start taking some questions?
Yeah, I thought it would be a good idea. I was just lobbing one question to Mr. Das before I sort of this thing. And that was basically, let's assume a mythical investor who's decided to do something on his own. And then, there has been a lot of misallocation of his funds. And he comes to you. How would you advise him, to change that portfolio? That's the final question before we take on the questions from the audience.
Oh, yes, there have been several cases in the last 30 years I've been in this industry. So first is give him comfort. Don't tell him all that you have done is wrong. I mean, that will put him away. People don't like, it's a big ego that you'll puncture. Although he's come to me because he knows he's committed mistakes, but then don't tell him on his face. Review his portfolio, explain where his mistakes were. Not that we can get everything right immediately. Take some time and then reconstruct the portfolio.
Great. Can we start taking the questions, Raki?
Yes, sir. So one question has come from Mr. Shayak Mukherjee. He's saying that, post first wave of COVID, there was a massive surge in markets and many funds and stocks had grown, giving investors good profits. And he has two questions: that why have we not seen a dip during second wave and lockdowns? And his second question is, with this boom, is there anything to worry about a dip or a crash again?
Deepak, take that.
Sure. So this is something that really amazed us, that markets really bounced back in April, after April last year. And when the second wave hit us, many of us thought that markets would go into a tailspin, and we were really surprised by the resilience. And I think I've covered it. The resilience is because of two reasons, in my opinion. The one is emergence of this Robinhood investing, retail investors becoming a big force and coming on an ongoing basis. Second is also people are maturing. It's more disciplined. People are realizing that, when markets fell down, they came back very, very sharply. So instead of really panicking and selling, they should hold on. If you don't sell, markets can't come down on their own. Markets are a function of demand and supply. So if there is no selling happening, no panic, very difficult for markets to really crash. So I think this is because of these two reasons, in my opinion.
If I may just add to that, the markets or the collective wisdom of the markets is always ahead of the press or the rest of the world. Let me very honestly tell you. Take the case of US. When the first wave hit US, California was the first state, I think, where there was a complete lockdown announced. But the US markets tanked long before California announced the lockdown. Similarly, if you take the Indian case, we are exactly at that situation. People know that the worst is behind us. Even if there's a third wave, the worst is behind us. The markets are telling us that. Don't challenge collective wisdom. Just move with the thing. I'm not saying get into that crowd and do what the crowd is doing, but don't challenge collective wisdom. Market is ahead of all of us.
Also, one more point. I mean, we sometimes confuse economy with stock market. Stock markets would represent what the companies are doing. And whether we like it or not, post demon, post GST, and then now in last 15 months, there has been a gradual shift from unorganized to organized, and becoming better. So a lot of companies which are strong, which have had the capabilities to really withstand the crisis, have actually grown. Businesses have grown, and many sectors, new sectors have emerged. There are no doubt sectors which have really bled in last 12-15 months, but there are sectors, technology, for example, healthcare, for example, which have really come up trumps. So there is that shift which is happening, and we should look at opportunities rather than be worried about what may happen all points in time. And markets time and time again have proven over a longer period of time that if the companies keep on doing well, the stock market returns will also commensurate with that.
Right. Thank you, sir. The next question is, there have been a couple of questions about the cryptocurrency and what is the future for it, and will it cause a dent in the equity market, and is it a good alternative investment option? This is a question from Mr. Ajay Jethi.
Sorry, no idea about cryptocurrency, blockchain. Absolutely out of subject. It's a googly question, and I say that I fail. I'll pass rather.
Let let me just sort of reword that. If crypto is not something that you want, but the question in the market is that how much of the market is really built on fundamentals and how much of it is just speculative froth. So that is something which investors really need to worry about, and when making those investment choices, whether it is in the primary market or it's through the mutual fund or whatever. I mean, that concern will always remain.
So good question. I think, and the answer lies somewhere in between. There is a lot of liquidity-driven demand, which we have discussed. But after almost a decade, corporate earnings are kind of coming back and looking up. If you look at last 2 quarters specifically, we have started seeing a strong earnings momentum. And I think the analyst projections from a next 3-year to 4-year perspective are very, very strong. I think that could be one big factor, which is also driving stock prices. If you look at last 10 years, the collective earnings growth was only 6%. And the decade before that, it used to be almost very high double digits. So India has seen a prolonged period of lack of corporate earnings. And if it comes back, there is no reason in my mind that stock prices wouldn't go higher. They may come down in between at any point in time because of event or other liquidity-driven shock. But if earnings keep on moving up, I think prices are here to stay.
All right. There are some basic questions, I think, from first-time investors. Can I ask those questions? They're very, very basic, like, in which category should a first-time investor invest, and whether right now is a good time to, start SIPs, and if so, then what kind of funds, and why mutual funds and not shares?
Okay, is it a good time to invest? Whenever you have money, is a good time to invest if you have time for that investment. Is it a time to start SIPs? Any time is a good time to start SIPs, because the whole idea of SIP is that you're cutting out emotions. You're looking at rupee cost averaging. So you have to start somewhere. You're not doing an SIP for 3 months or 6 months. 3 months in the short term, markets will go up and down. 6 months, it will go up and down. 6 years, it will go up. That's history. So SIPs, anytime is a good time to start. What was the other point?
And whether,
shares or mutual funds?
Shares or mutual funds.
If he's a first-time investor, let him focus on what he's doing best. Maybe he's in a job, he's in a profession, he's an engineer. Let him do his engineering and leave the selection of stocks to the fund managers for a small price. Definitely mutual funds for the common investor. Shares, you need that bandwidth to do the research, and that bandwidth is there with the mutual fund houses. Pay them the fees and take that research. Simple.
Thank you so much. And the next question is about index fund. Any inputs about how optimistic it is going to be and how is it going to move? It's a question from Mr. Gautam Kumar Sinha.
So,
okay, I mean, the god of ETF investing. I mean, he is actually John Bogle, Vanguard. He said that don't search for a needle in the haystack, buy the haystack. So if you believe in that, index fund is definitely good. But I think in India, it should be a mix of the active and passive schemes, because there is a lot of opportunity. It's a developing country. The markets have not matured. There'll be inefficiencies in the market. And I think the fund managers have a great opportunity to outperform the benchmark indices for the next 10 years at least. Having said that, buy the haystack, forget the needle, you'll get it anyway.
All right. The next question is again from Mr. Shaya Mukherjee. Is asking that as retail investors, can we invest in US markets, specifically in global companies like Amazon, Facebook, Google or Tesla, and how can people do that, and what is the direction for that?
So let me take that question. Yeah. So there are 2 ways in which you can invest globally. One is through this LRS scheme, liberalized remittance scheme, that RBI launched almost 20 years back, where a certain amount that RBI fixes, and I think this point in time it is 250,000 per person, that can be converted into dollars and stocks can be bought abroad. Or the second way is to buy a fund which invests into those companies globally. So there are many international funds feeding into global funds, whether it is US centric or the entire globe being the basket, or country specific or theme specific. There are multiple opportunities today available in Indian market. The entire category has grown to almost 30,000 crore of AUM. Just about 15, 18 months ago, this was less than 2,000 crore. So the interest among investors about global investing has really come up the curve in last 18 odd months. So people can choose either of the way.
All right, sir. The next question is from Mr. Swaroop Bhattacharjee. He's asking that, with respect to investment, is there a magic formula in case someone wants to invest for 15 years or more? And what is the ratio of investments between debt, equity, fixed deposits, other investments? Is there any magic formula?
There's actually no magic formula. It will depend on the age when he's actually starting. If someone at 20 comes in and says that I'm going to look at the next 15 years to create wealth, I would say equities. 100% equities. If somebody at 50 says over the next 15 years, I'm trying to save some money to ensure that I survive after 65, it'll be a different mix. So it all depends on the age vis-a-vis what's the time frame he's got.
Can I add?
Sure, sir. Please.
There are a couple of things which an advisor would do, apart from the basic profiling with regards to age and etc. Two things, which is risk tolerance and risk appetite. You may all have the appetite with regards to your profile of age, etc. But can you tolerate? Can you really withstand that risk? So there are certain formula, there are certain questions, there are certain techniques on the basis of which the advisor can come up to a solution where whether it should be 70% or 100% or 50% equity. On the basis of that, one can actually invest for long term. But yes, if you have the time with you, let the market really make work for you.
All right.
Can I just jump in with the question? Sorry, can I just jump in? Okay, my question really is, okay, there are 6,500 stocks that are traded on the BSE, right? Now, out of that, if you look at the mutual fund portfolios and look at the, the top 10 in this thing, you would find probably that the choices would be limited to about 200 stocks. And most of them would, many of the schemes would sort of replicate the portfolio. Does that in any way happen, and do returns get affected by that?
No, I don't think so. So if you go by the official classification of, let's say, large cap, mid cap, and small cap, the top 100 companies represent the large cap. The next 150 represents the mid cap, and anything above below 250 companies in terms of market cap are the small cap companies. Today, small cap funds have size of 4, 5, 7, 8,000 crore. The entire segment is more than 1 lakh crore. So a lot of portfolios have companies which not many would have heard in the normal course. A lot of research has been done by the industry as a whole, and a lot of investment has been made in various companies. And especially in the small and mid cap space, there's not lot to really research, find out good companies, find out businesses which are not really owned by a lot of other people, and that leads to a better price discovery and opportunity of alpha generation. So yes, you may see a lot of commonality in terms of names in a portfolio which is a large cap or a multi cap, but again their weights would be different. So for example, somebody may have a top holding of X stock, but the active weight compared to the benchmark would be very, very different. So it's very important to look at active weight vis-a-vis just a presence of that portfolio and the weight that assigned is to that stock.
So the next question is for a person who's above 70 years, basically a retired person. Can he still start investing in mutual fund if he hasn't? And if so, then what kind of funds? And even for people who are planning for a retirement portfolio, what is the kind of mix that they should go in for?
So I would let Shibuda also add to this question, but this is a subject which is very close to my heart as far as retirement is concerned. There are two elements to this. One is planning for the retirement, that is building the corpus till you retire, so while you're earning. And the second phase is once you have really retired, the corpus must be available to you. So accumulation phase and then distribution phase. In India, in last 10 years, we have been successful to make SIP, for example, very household name, a name which actually has become a brand in itself, which is basically accumulating money to create a goal. But the distribution phase, where you actually have the corpus and you want cash flows over a period of time. So you would retire at, let's say, 55, 60. Sometimes people want to retire early, but you tend to live a very long period, based on the fact that health facilities have become better and better. But the traditional way of investing into that retirement corpus has been fixed deposits and fixed instrument. But that may not be enough. The money may not really survive the entire period. You may outlive your money. So there has to be a product or product category which takes care of the growth element of that money also, and not necessarily the income element. And that's where some of these solution-oriented hybrid products come into picture, which can actually really help you. Shibuda, over to you.
Yeah, actually, we had a very old thumb rule that once you retire at 60 or 65, maybe, you plan for the next 30 years. So this was a US rule. It said 4% drawdown. The point is, if you've got 1 crore rupees, the formula was you draw 4% every year, and that is good enough. It will last you 30 years. But with the interest rates and all changing, I think that research is a bit outdated. So these days, we would say that in that particular 4%, the assumption was 50% would be in equities and 50% in debt. Now, you cannot survive with a 3% withdrawal. Neither can you actually withdraw 5%, because 4% is sacrosanct, we thought. So what we have to do is we have to increase our aggression a bit, maybe build a portfolio which is 65% into equities and 35% into debt, so that you can still draw that 4% and survive 30 years. So 4% is the thumb rule. And we normally say a 65% equity and a 35% debt with a 4% drawdown every year should be good enough for a retirement portfolio. But then it has to be customized. Each individual's needs are different. Their situation in life is different. So one retired person can be different from the others. So 4% with 65-35 allocation.
But the good thing is that you have choices. You were mentioning about the prevalence of so many schemes. Today you have a 65-35, a 35-65, or something which can actually go between 30 to 80. So depending upon a customer's requirement, you can either choose a conservative hybrid fund, an aggressive hybrid fund, or a dynamic hybrid fund, which moves on the basis of a certain model. And all these are there to do two things. One, take care of volatility and reduce drawdown, at the same time provide that growth element in your retirement portfolio, which is very, very important.
Right. The next question is that, we usually used to say that if you do an SIP, you should minimum give it a 5-year term to show results. So, but last couple of years, there's been a lot of downturn. The downturn had already started before the pandemic hit. So the question is that even after 5 years of SIP, if someone's returns are not up to the benchmark, it's below the benchmark, what should the person do now?
So if I were to answer that question, I don't think the presumption itself is correct, where you only start for 5 years. If you look at most investments in India, whether it is recurring deposit, your PPFs, your life insurance, I'm talking about the endowment and the ULIP part, you do for 10, 15, 20 years. When it comes to a little high risk, high return investment like a mutual fund into equity market, I think the horizon could be same, if not more. We have discussed the benefit of long-term investing. From 1979, if you calculate the XIRR of Sensex, it is 16%. It has gone up 420 times in last 42 years. So if anything, if past is anything to go by, which we comes with a very strong disclaimer, but we have nothing to look at as far as more data is concerned. So I will stick to that 15% thing. It can actually make a lot of sense if you look at your investment of SIPs for 10, 15, 20 years and not necessarily stick to 3 to 5 years. This short-term approach is a phenomenon of last 20, 25 years. If you go back in time, from 50s, 60s, Indians have always invested for long term, whether it is investing into businesses, investing into some fixed term instruments, buying a property. I think it has always been for long term. Gold, for example, nobody sells their family gold, but and the returns have been very poor, I would say, from an inflation adjusted point of view. But yet people invest that for a long period of time. I think SIP should also be for a longer period of time.
Yeah, which is also linked to the next question that I'm going to ask. This question has come from Mr. Srideep Mukherjee. He's saying that what is your take on investing in real estate bonds versus sovereign gold bonds? And suppose if a person had about 20 lakhs odd to invest, what is the recommendation? Should he go in for real estates or get into mutual funds or stocks? What is the best option?
Deepak, you take this. You're good at real estate.
I'm not necessarily good at real estate, but the question is real estate bond. I don't know what real estate bond people are talking about. If you're talking about REITs, I think you really have to get into each and every instrument and look at it very selectively. As far as sovereign gold bond are concerned, I think it's a way to, government is trying to monetize some of it, move that gold and get that money flowing into the system. And it also pays you a certain interest on that. So your gold is actually starting to yield something. Apart from that, I don't see it as a strong investment case and it's not really for wealth creation. If you have wealth, you can preserve it via gold. But I don't see gold or some of the real estate arguments being a wealth creator kind of an argument. And in an economy where inflation is low, most of money is moving towards financial instruments rather than hard assets.
All right. So the next question is that people are asking about how can they get hold of this technical advisors who can advise them. I mean, they want to invest in mutual funds, but how should they go about it? They need some technical advice. I mean, basically, how to go about allocating.
So, I really don't know what is meant by technical advice, but yeah, advice with regards to choices of schemes, way to invest, etc. There are SEBI registered RIAs. There are MFDs who provide basic advice as far as selection of mutual fund schemes are concerned. You can look at AMFI. You can look at various websites like advisorcoach.com, for example. In our own website, find an advisor, find an MFD is an option. So if you go to Edelweiss website and look up that, you will find nearest to your residence. So by the help of Google Map, we'll be able to tell you which are 3, 4, 5 people you may get in touch with for seeking any advice or suggestions. So there are more than 150,000 MFDs in the country, ARN holders in the country. There are more than 3,000, 4,000 RIAs in the country. So all of them put together provide you a great talent pool, which can actually advise you. Shibu, if you want to further add to this.
I think you've covered it well. Yeah.
And of course, I think we're out of time. We've already, 5 minutes extra now. But last question, I think, given this global recession and pandemic, where people have lost jobs, lost their lives, but still have, of course, there's hope to move on. Now, how should they start with their investments in this current situation?
I'll answer it in a different way. I think it's my favorite way to answer any question with regards to how to select a mutual fund. I think mutual fund is like a choice of an automobile or a vehicle from a transport point of view. If you got your vehicle right, I think the rest would be taken care of. When you buy a car, for example, what do you ask? Do you ask how the markets are, how the weather is going to be, how the road condition is going to be? You don't ask all that question, because that's not a manufacturer of automobiles can answer you. He can answer, is this car good enough to withstand all conditions? Is this car good enough to provide you speed as well as resilience, safety as well as speed, so returns as well as risk? From an investment point of view, if you were to correlate the two, you can actually come to a conclusion where vehicle is more important, not necessarily the conditions. Conditions will change. You don't change your vehicle because on your way you have seen a beautiful bright sunny day turning into a foggy and rainy day. You need your vehicle to be prepared. So if your vehicle is prepared, I think your journey would be smooth.
So I think that's about it. Any last comments? So Mr. Dasgupta, any last comments? Anything to round up the discussions?
Yeah, we have had a really great session, and thanks to Mr. Jain and Mr. Das, we really, went into a whole lot of questions and fielded a lot of, maybe silly questions at times, but also give us a lot of info about the mutual fund industry and its working. And so thank you so much for that. Investors, I hope, or the audience who plugged into this webinar were able to find some of the answers that they were looking for. And so, yeah, all in all, a great session. And thank you all for calling in and listening to this webinar.
Well, that brings us to the end of this very interesting session today on growing your wealth in turbulent times, brought to you by Virtual Insights and ABP Initiative and Edelweiss Mutual Fund. I would like to sincerely thank the speakers, Mr. Saumitra Dasgupta, Mr. Deepak Jain, and Mr. Shibu for taking time out today and joining us for the session. I thank Edelweiss Mutual Fund for partnering us in this investor awareness initiative. Needless to say that mutual fund investments are subject to market risks, and you must read all scheme-related documents carefully. I thank all the attendees for such a phenomenal response. I mean, people have stayed logged in despite the fact that, we've shot over time. Thank you so much for your patient hearing and your interest in the session. We shall keep you all posted about the next session. And if you want to see the recording of the session, you can also have a look on our Facebook page for the event, which is ABP Virtual Insights with Edelwiess AMC. And till then, till we see you for the next session, we're signing off now. Be well, be safe, and stay virtually connected. Thank you very much.
Thank you.
Thank you.